Hello everyone, and welcome once again to our quarterly review of the Sasfin Global Equity Portfolio. As always, I'm joined by my colleague Craig Pheiffer. Craig,
hi Jonathan.
Good to see you again.
Yep, good to see you. Nice to be back. It was a quarter that started with a whimper and finished with a bang. So nice to chat about it again today.
And markets continue to reward those that are invested. Lots to unpack. Maybe you can just take us through what happened with the market this quarter.
Yes, well, April, the first month of the quarter, was pretty poor. I think we had a down month across the board. Whichever index you wanted to look at was negative. And it was all about interest rates and the interest rate story, and just waiting to see when we're going to cut interest rates. There was a disappointment after that April sort of June dot plot, or the summary of economic projections from the Fed. They kind of trimmed back their expectations. They also did that later in the quarter, and we saw that they were only expecting one interest rate cut for the rest of the year. But the market's looking past that. I think they're expecting rates will be cut. I think we started to see more positive earnings news coming through, and that lifted the market as well. Mostly those big tech stocks coming through with all of the earnings. But we finished the quarter then with two very strong months. And I think that was the bang that we finished the quarter with, as opposed to the whimper that was April.
And beyond interest rates, maybe you can just touch on some of the other macro things that are taking place that's driving these markets.
Well, there's a big overlay of elections going on around just about half the globe is at the polls this year. So a lot of that's playing out on top of the market and the macro environment, maybe distorting things a little. But overall, on the global level, we're seeing global economy slowing, but stabilizing. I think this last quarter or so, we saw the IMF and the World Bank coming out and saying, in their own words, that the global economy is stabilizing after 3 years of decline. So we're kind of getting to that even keel for now, and that would likely allow for interest rates to come down, and then we can start getting a bit more the easier monetary policy along with some fiscal policy, trying to get those economies turning over again and getting demand up. And ultimately that will feed through into earnings, corporate earnings. I think the expectation is still for quite positive earnings growth for our companies, for the rest of this quarter or the next quarter, and the quarters for the rest of this year and into 2025. So I think there's that economic story is playing out in the background. Bit of a stabilization, hopefully slowly pick up with interest rates coming down more modestly than before. We're not going back to zero interest rates, but a couple of cuts would certainly give the markets a bit of a boost.
Sticking with a bit of a positive vibe, and we move on to the global equity portfolio itself. Again, another good quarter for us, outperforming our benchmark relatively. And I think we mentioned one of the themes that's driving the market, this whole AI thing still just seems to be gaining momentum. We've got a fairly sizable weighting to tech stocks at the moment, a little bit more than our benchmark, and a lot of those tech stocks did really well during the quarter. I suppose the one we have to mention nowadays is Nvidia. Maybe you just want to talk about Nvidia and how it went through the quarter.
Yes, again, shooting the lights out in terms of earnings results and outlook. The whole market the whole AI complex is demanding smarter and faster chips, and Nvidia is bringing those to the party. They still have sort of their dominance in their software that helps produce those chips, or not. They don't manufacture them, but design those chips is what the words I was looking for. They still have kind of the global monopoly on that. And they keep coming out with newer and newer versions and newer technology. And while they're doing that and exciting the market, and their earnings have been growing exponentially, the rest of the market's coming along with it on the AI front. And for a brief moment in time, they were the world's most valuable company. just falling off a little bit towards the end of the quarter. But it's all been around growing revenues, still an improved outlook. Although there are lofty valuations, the company certainly can justify those valuations.
It's absolutely incredible that a company like Nvidia, in such a short space of time, became the world's most valuable stock. As you mentioned, quite briefly, it lost its crown. One of those companies that used to sit on top of the pile was Apple. It's still up in the top 3, but it also had quite a good quarter. It came out with some news around what it's doing on AI. Maybe you just want to touch on that?
Yes, I think there's been much awaited news around Apple and how they're going to hook up and bring artificial intelligence, that concept, to mobile phones and their mobile devices. And at their developer conference, they started explaining how they're going to bring in Apple intelligence into their mobiles. And that was the news that the market wanted to hear about. The earnings will likely follow, but the sentiment definitely improved. And of course, we're getting closer now also to September, where we'll get the new iPhone 16 and thoughts about what's going to go into that, and is there going to be a new button, and all that buzz and hype. But I think the buzz and hype this last quarter was around the inclusion of this AI into their mobile devices.
Yeah, I think the whole thinking, at least the way the market's viewing it, is people are going to want to be able to access these AI capabilities, but they're going to have to upgrade their existing iPhones to do so, and that should spur on the earnings for Apple, which has actually been a bit sluggish of late. A lot of concern around the growth for the company. Perhaps this AI, or this Apple Intelligence, as it's aptly named by the company, might spur on some growth for them. Well, at least we hope so. If we move a bit away from the tech side, it wasn't all positive during the quarter. There were some detractors from our performance, and I think the one space that we still see a bit of a underperformance is the healthcare space. The stocks seem to be lagging the market. The one big exception is, of course, Novo Nordisk, the company that's basically pioneering these weight loss drugs. It once again had a wonderful quarter. Earnings just continue to grow as people can't get enough of the weight loss drugs. But on the negative side, Johnson & Johnson and IDEX maybe detracting from performance. Their results a bit underwhelming during the quarter. Another sector which lagged a bit, consumer discretionary. Lots been spoken about the consumer coming under strain at the moment, with interest rates being as high as they are. Two of our stocks, LVMH and Home Depot, maybe you could just touch on those, what's going on, their underperformance.
I think a lot has to do, as you mentioned, with the high level of interest rates. If you look at the Home Depot side, household spending or discretionary spending, or what you've got left to spend, once you've paid off your interest costs of your house and on your loans, you've just eaten into your household or your ability to spend more. So one of those things that you would cut back on is investing in your house or spending more in your house. So I think that's one of the more discretionary, aptly named discretionary spends that you just hold back on. And hopefully in time, as interest rates come down, people will have household incomes, or disposable incomes will increase, and we'll see that spending, come back into those kinds of things that Home Depot sells, the DIY and the like. So not really a concern, I think just part of the cycle. It's still a company we like from a quality and growth point of view, but that's going to ebb and flow over time. And sometimes we like to think that those with the big bucks aren't really impacted by economic cycles and interest rates, and they spend anyway. But we have seen a bit of a slowdown in the luxury space globally. It's not just an LVMH issue. A lot of that's also been the slowdown out of China. China really hasn't kicked off. We see that in all companies that are exposed to China in one way or another. That economy is growing at 5% last year, likely to grow even less than that this year, maybe 4.5, 4.8 or so. But that has an impact on the health of that economy, on the goods and services demanded from the rest of the world. And luxury is no exception. So we're looking to hopefully see an improvement in the Chinese economy again over time, and that will lift those companies again. But it was a soft quarter, it's been a soft year after really shooting the lights out the year or so before. So again, part of the economic cycle, and those luxury goods companies just aren't exempt.
And of course, the French elections creating a bit of noise around those companies. The LVMH wasn't too badly impacted by what's going on there. But on the discretionary spend, we can actually move on to the changes we made during the quarter. One of those companies that discretionary spend is a factor, Nike. It's a company we sold during the quarter. Maybe we can just touch on some of the reasons why we decided to exit the shoemaker.
Well, firstly, Nike, we've had some concerns around their longer-term growth profile, and the shorter-term news wasn't that positive. Growth, earnings had slowed, and we were looking at their direct-to-consumer strategy, cutting out the middleman, the wholesalers, and moving directly to that end consumer of their goods and services. And we were looking to that, as they were, to finally uplift sales and really get that growth going. But they've started kind of reversing a bit on that strategy. It hasn't been playing out well, and those concerns around growth remain over the longer term growth. So great company, great products, running the shoes myself, but whether that makes a good investment over the longer term is what you have to think about. And we thought no, and there were better opportunities. So we got out of Nike in the portfolio.
There were two other companies we exited during the quarter. One being Nestle, more on the consumer staples side. The other one being Honeywell. If you can just touch on the reasons for exiting those two companies.
Well, let's start with Nestle again. Quality company. Great track record of earnings, but the earnings growth from this very mature company just not meeting our hurdle rates, and not expected to meet our hurdle rates over the longer term. So it was mostly around growth concerns, not really specifically anything with the company itself. Just doesn't have the growth profile that we're looking for over the longer term. And then Honeywell, again, a company, multifaceted company in lots of areas, a lot of hope around them benefiting from a lot of the mega trends going on in the defense space, in the AI space, and numerous sectors that they're involved in. But again, disappointing in the short term, with the prospect of maybe not getting that growth also that we want to see out of our companies that we invest in for our clients over the longer term.
One of the replacements, not quite a direct replacement for Honeywell, company we added to the portfolio this quarter, TransDigm. Maybe you can just take us through what they do and why we like them.
Yeah, TransDigm is an exciting addition to the portfolio. It's a company that produces and manufactures a lot of the bits and bobs and pieces that go into the makeup of an aeroplane. So it's in the aerospace industry. They make so many different parts from the cockpit security to the lights by the toilet, or the upholstery, to parachutes, to a lot of the bells and whistles. But the key thing is that they have a lot of that proprietary technology. They're the only ones who do that. And those airplane manufacturers, the Boeings, the Airbuses, they are not going to quickly change their suppliers. We've seen Boeing and the troubles they're going through. They need to have full confidence in the pieces that they put into their plane, wherever they be. So they have that dominance. They have a lot of their own IP, proprietary technology. 90% of their revenue is in their proprietary technology that they've got patents on. So you've got a lot of recurring revenue in that space, a lot of proprietary income, as I said. And it gives us an opportunity to play the aerospace theme without buying a Boeing or an Airbus specifically, with the issues that those, for the plane falls out of the sky, there's issues for that particular airplane manufacturer. But you're still going to need all those bells and whistles and bits and pieces in those aeroplanes. So as they produce new ones, new aeroplanes, and it goes in the defense space as well, so it's also a way of playing the defense side, the Black Hawks, the F-35s and the likes. They also supply parts for that. So we can play the defense theme without actually going into missiles and all of this hard stuff in that space.
Controversial items.
So we can play defense, we can play aerospace without buying particular airline manufacturers. And again, it's a company, they do have quite an acquisitive growth profile. They do acquire companies, they beef them up, they improve their margins, and again, it's in that proprietary technology space. So I've waxed lyrical about the company, but we like it a lot. I like it a lot, and it's going to give us that growth profile that we need over the longer term, and a great track record as well.
Another company we added during the quarter, Stryker. It's in the healthcare space. As I mentioned, it's going through a bit of a underperforming patch at the moment, but we like the area of healthcare. And Stryker is a company that basically manufactures medical devices, but it's quite diversified across its product range, which we like. So if any particular niche goes through a difficult patch, at least it's got other areas to make up for that. But Stryker is best known for its orthopedic pieces of equipment, specifically hip and knee replacement. Chances are, if you've had one or you know someone that's going through one, they've used, or the surgeons used Stryker's equipment to perform those procedures. But it's also, again, a company with a long track record, nice defensive, yet also offers a bit of a growth profile. So we're quite excited about that company as well.
Very much so, and just the thought of those robots working on your knee, putting in a new steel or titanium knee joint, they just got it down pat. I think to your point, it's around that growth profile over the longer term and the diversity of their earnings.
And of course, it plays into that broader theme that we've seen of aging populations around the world. More people are probably going to be requiring those type of surgeries, so they've got quite a secular growth trend behind them. If we move over now, a lot of people are saying, okay, we had a good quarter, what now? What's the outlook? What are some of your thoughts about what we're going to see ahead?
Yeah, the earnings growth has been driven by a handful of companies, and we talk about the 5 out of the 500 that have really driven the S&P 500 earnings. But there is a broader base of improvement in earnings as well coming through, and that should improve also with lower interest rates and a bit more of a pickup in the economies over time, particularly the US economy and the global economy. But earnings growth should continue to improve on a broader level. So I think we're going to stick with our technology companies. I think they're going to continue to improve. We still manage the portfolio, do a lot of risk management. We monitor which of our counters, and Nvidia's doubled, and it can become a very large part of your portfolio, but we typically trim it back, and we use some of those funds to invest more in the likes of TransDigm and some of those other opportunities that we see. But I think the outlook is still positive for the markets, from the earnings growth, the fundamental earnings growth side, and I think just around the sentiment.
For those that enjoy reading our quarterly letter, there's 2 things we do touch on, which you can read about in more detail. 2 concerns that are sort of doing the rounds in the market at the moment. The one is, with markets doing so well, they're making new highs. And a lot of people get quite scared when markets make new highs, because your immediate thought is that the market's going to fall because it's at such a high. But if you look back in history, when markets make new highs, the thing that tends to follow is even newer highs, which might sound a bit counterintuitive, but that tends to happen. And the other thing is around concentration. You mentioned a handful of companies driving the earnings growth. So you've seen a couple of these big tech companies making up a big portion of the market, as well as what's driving the market upwards. So there's concern that there's concentration, which translates into, are we in a bubble at the moment? If you look at the history as well, typically during bull markets especially, the market does become a bit more concentrated. It's just how things work. And we're not, at this stage anyway, we don't think the market's in a bubble. We're not too concerned about the concentration as it is, as long as the fundamentals are backing up what's going on. And that's what we are seeing. The fundamentals are supporting these companies. But you can read more about that in our quarterly letter.
Yes, I mean, Nvidia is going to disappoint at some point in time. It's inevitable.
It's inevitable.
And it's not our job to guess, or try and get out the week before that that happens. We look at the longer term picture. As you say, we continually looking at the underlying fundamentals of all of these companies. We maintain a diverse portfolio, so we've got our healthcare, which is underperforming at the moment, but it will have its day in the sun again. So we avoid that concentration risk. We continually monitor. We look at all the earnings with a fine-tooth comb, and we're happy even with that concentration risk. And to your point, the market, I think in this first half of the year, the S&P made something like 31 or 32 new all-time highs during those 6 months. So if you got out on that first high thinking that was it, you would have missed out on a fair amount of the market this year.
Craig, I think that's a great point to leave it at. I think we've got a lot of interesting things to look forward to, but for now, I think we'll close it there. And I'd just like to thank everyone for joining us today, and we'll see you next quarter. Keep well, everyone. Bye for now.